Okay. My name is Mohammed Kashif. I am a fellow member of Association of Certified Chartered Accountants. I had been working and providing services in UK, US, Pakistan, UAE and Qatar. So before we really start, it will be non-stop session, and I think after food it's difficult to even speak. I think it's going to be more difficult to listen. So we will continue the session till the end, and then we will have a question and answers. But definitely during the session, you may come up like some ideas, some questions. So just for easiness, if you keep it ready, maybe it will be good if you can write it or send the question on this WhatsApp number. At the end of the session, we will go one by one and try to answer all of it. So, what is corporation tax? About 5 years ago, as Mehnaz said, UAE introduced a tax called VAT at 5%. Well, what is this now coming? 9% corporation tax. There are certain terms which we use normally can mislead us. Some is like talk turnover, income, profit. So exactly where 5% is applicable and where corporation tax is applicable. Just to clarify this, you might have seen something like this in your own businesses. You have turnover, and then you have a direct expenses. You have profit, gross profit, some indirect expenses, and then you have a profit, which normally people distribute among partners and investors. So where does this 9% will apply, and where does this 5% will apply? So this 5% basically apply on the turnover, and this 9% will apply on the profit. What it means is, when 5 years ago the VAT came, the government said, we are your partner, but we are not partner in your profit, we are partner in your turnover. No matter you make profit or loss, whatever turnover you're going to make, whatever sales you're going to do, we will take 5% of it. Or they ask you to become their agent, collect the VAT, and knock off the VAT which you pay to other people and pay to us. So most of businesses, it has almost no impact on the bottom of your income. You're collecting VAT, you paying VAT to other vendors, the net difference you pay to the government. But here, this corporation tax is going to impact your profit. So, for example, if you are in the partnerships, some of them have, let's say, 3 partners, 33, 33, and 34%. Now you have another 4th partner. And that 4th partner will take how much? 9% of your profit. So it has a huge impact on businesses. They need to check their sustainability. Some of the wholesale businesses, for example, they work at very less margins. So for them to come up with a 9% from the profit is a huge amount. So we'll look into the detail in a minute. So before this, let's first think of who is applicable to. There is corporation tax from organizational point of view. All kind of businesses, no matter what they sell, where they are based, what is the type of the business. They all are taxable. They will come under corporation tax unless explicitly mentioned by the law. So here is almost 8 categories. We will focus among them only one category, which I think which is more relevant for us and the audience. The government entity, definitely they will be exempt. Any organization controlled by the government entity, or any department controlled by the government, that will be exempt. Extractive businesses, this is basically about natural resources. If you've been given a license to extract, for example, you mining for fuel and gas, those businesses will be exempt. But it does not mean anyone work with those big companies like ADNOC or any one of them as a subcontractor, because that's the kind of activity not given to you, but your main company, which may have the license of extracting those natural resources. And similarly, any companies which are dealing with other natural resources, other processing like um, what we call it, after extracting the fuel, what we do? Refinery businesses, for example. So those will be exempt. This is basically where IBC come, not for profit. There are certain conditions which need to be fulfilled. Once it is fulfilled, these will not automatically be exempt. You have to apply for the exemption. Similarly, we have a qualifying investment funds. These are the funds supervised by different bodies. There are certain conditions. I won't go into the detail. Similarly, there are some other pension and social security fund, which is mainly for locals. These will be also exempt, but here is it free zone. They call it qualifying free zone. This is not exempt, but the tax rate will be 0%. We'll go into the detail in a minute. So after looking at the different organization, now we want to see actually if even the exempt company, a government body for example, they do certain other kind of businesses. Does that mean this will still be exempt? No. So first thing first is by default there will be companies and organizations will be exempt. Some of them will apply for the exemption, but in detail, what is really taxable income? So anything which is coming from your normal day-to-day business operation, and that is, we call it accounting profit. So that is basically a taxable income. What are the other exempt income? In your company or as a person, if you receive a dividend from other registered company in UAE, or you receiving the profit distribution from a partnership, or you're receiving a salary, and you can also receive income from foreign establishment. You might have guest houses in Spain. You receive certain rent and rental income from there, and income derived by a non-resident person from operating aircraft and ships. This may also be quite applicable to quite a few of your people. So if you're non-resident and owner of aircraft and ships which are operating worldwide for taking passengers and transports, the earnings derived from that kind of business will also be exempted. Right. This is interesting and confusing. So in Qatar, in KSA, in many other local regimes, what happened is they made basically taxability based on nationality as well. Locals are exempt. But in UAE, that is the major difference. No matter if the person is Emirati or GCC national, corporate tax is equally applicable on all of them. What is the deciding factor is their residence. So in other words, if you have Emirati residence card, you are resident. If you don't have a residency. But if you are resident, basically, then your worldwide income is coming under corporation tax. Worldwide income. So any income you generate from UAE through businesses which are incorporated, through businesses which you can say sole establishment or anything, these will be taxable. And even the businesses you incorporated outside UAE, but you are controlling them from UAE, then these will be also taxable. On the other side, non-residents will also be taxable, but not for their outside income. Outside UAE income for non-resident will be outside the scope. But if they drive any income, let's say I am Emirati and I'm sitting in Germany, but I have businesses in UAE which is giving me income, then these will be taxable. So income through permanent establishment could be your business, could be your property. And it's state source income is also an income which is, you drive it from UAE resident. For example, you're providing expert services to a company based in UAE. So basically, you are taking state income. So on that, you will be taxable. And we will come back on this non-resident in a minute. There's one more thing which will be linked with it. Now, we'll a little bit talk about different type of establishments we have. In UAE, you can do business through LLCs, through civil or normal partnerships, and through sole establishments. And there's one term which we use in all of this is distribution of profit. When we take the profit in these organizations, we call it differently. So LLC, we call it dividend. We receive dividend against our shareholdings. In partnerships and civil company, we receive share of profit. And if we run our own sole establishment, self-employment, there are so many terms for it, you can simply call it drawing. But when and it is also a very myth saying, oh, we don't have any income in the business. Actually, we consider after withdrawing all the benefits, then we think, oh, the bottom line in the bank is nothing. It does not mean you did not earn. So the corporation tax basically applicable before the distribution, no matter which type of entity you become. Right. Qualifying free zone person and income. What do we, let's I think we can keep each other wake up by cross-questioning. Anyone who knows what are the free zones' main purpose?
Tax-free.
Tax-free. I just heard. Yes. So they want to keep that narrative still alive, that if you have a business in free zone, that will be a tax-free. But tax-free on qualifying income. Qualifying income will be discussed and we will have a further detail once we have the further legislation, we call it executive regulations. When it comes, then it can further define. But in a nutshell, you've been given a mandate when you're given a license. If you keep working as per your mandate given within free zone, you basically you're driving a qualifying income. That qualifying income will be taxed at 0%, and 9% will be applicable on anything which is not qualifying income. Right. Well, one threshold you might have seen in very first slide, 375,000. That is about the profit. So even large companies can make losses, can have a turnover of billions of dollars, but they may result in minimum profit or even losses. For that, 375,000 is the threshold. If they earn more than 375,000, they have to pay tax at 9% on the top of 375,000. But the government said in this legislation, they will announce a relief for small businesses in which they will define a threshold of the revenue. From that revenue, if you have that much revenue and less than that, then it will be assumed that you are not driving any taxable income. So the corporation tax may not be applicable on you. When UAE corporation tax will be effective? See, the law say from 1st of June 2023 onward, it will have an impact on the businesses, especially any business whose financial year start after 1st of June 2023. That particular year will be considered as a tax period, and they will be taxed accordingly. So for example, one of your most businesses here, people do maybe as per the companies in their back home, align with them, their financial year end, but a lot of companies, what they do is with the calendar year. They start their financial year by 1st of January. So just to further explain it through an example, if your financial year is starting on 1st of July 2023 and ending on 30th June 2024, will become subject to UAE corporation tax from 1st of July, which is the beginning of the first financial year that starts on or after 1st of June 2023. Similarly, a company having a financial year starting on 1st of January 2023 and ending on 31st of December 2023 will become subject to UAE corporation tax from 1st of January 2024, not from 1st of January 2023, which is the beginning of the first financial year that starts on or after 1st of June 2023. For example, in this case, 1st of January 2024, the year end will be 31st of December 2024. The corporation tax will be due after 9 months. So it means, within 9 months. That means the due date will be 30th September 2025. Right, okay. There are so many bits and pieces. I will try to, at the end, put them together to make you understand. There are some reliefs available. And one of the relief is called transfer within qualifying group. The other relief called business restructuring relief. So these reliefs are basically related to the more than one of the company. It's not like, it's talking about a group where one company owning certain shares of the other company or the control. For example, the transfer within qualifying group, the qualifying group conditions are both companies should be juridical person. What does that mean is not taking into account the natural person. Both companies must be incorporated companies. And one of the company owns 75% of the shareholding into another company, or one company jointly owns 75% ownership of more than of two companies. For example, you have a parent company, you have 75% in one company, 75% to another company. So directly or indirectly, if you have this kind of shares, both companies should not be exempt. What does that mean is, we saw that exempt categories, these companies should not be among the exempt category, and they should not be a qualifying free zone person. The financial year of, you will see that most of the relief we will see later on, the two conditions must be there. The financial year must be same. The second condition is they follow the same international accounting standards. So if that happens, it means the transfer of assets and liabilities will not be considered for any gain and loss. So it means the fixed assets, it means the assets for trading, anything, if they are that much closely linked with each other, no gain or loss need to be considered in determining the taxable income in relation to the transfer of one or more assets and liabilities between the taxable persons. Another relief is business restructuring relief. Business restructuring relief where you have a group and you want to acquire or you want to finish one company and you want to sell one independent part of your business, etc. Same condition as in the transfer within qualifying group, the same conditions should be there, but also the assets and liabilities shall be treated as being transferred at their net book value, so that no gain or no loss arises. But if they consider more than that, that means they are not transferring the assets and liabilities. So to make sure there is no gain or loss arise, they need to transfer the business as per the net book value. In that case, they do not need to consider if there is any gain or loss happening. This is a very important slide. So, from accounting point of view, we can consider this is my profit. After me as a, for example, director of the company withdrawing 1 million dirham salary, my brother is also working, he's also withdrawing 500,000 salary. We're paying luxurious expenses from the company to cover our family cost even. And we think, okay, this is our profit. That profit could be different than what your partner thing. For example, me and Amr is a partner in one of the business, and we start together, and we sitting on the financials, and Amr think there is more profit than what is showing on the profit and loss. And you have taken these expenses into the consideration. This is your personal expenses. So there should be a more profit which we should share among each other. Same arguments can be done by the government. These expenses which you incur may not relate to your business. You paid cosmetic surgery from the business account for your wife. How come it related to the business expense? So the number one condition is the expenditure wholly or exclusively for the taxable business that is not capital in nature shall be deductible in the tax period in which it incurred. Otherwise, if it is not for the business, I can go and buy, let's say, Bentley or expensive cars. But is it as a CEO of the company, or is it for my personal use? So those will be considered. So the expenses must be for the business, and these are allowed to be deducted. And the expenses which are in capital nature. So this is also where confusion happens. Not all the business owners are from accounting background. So what they think from the cash perspective, we have generated this much cash in the business, we have done these expenses, so our profit is less. We did not do much about it. And how come we pay tax on it? We were not crossing 200,000 a year. But they forgot, they bought an office for 1 million, I'm just saying. And they expense that out. Since they made a payment, so they take it out and they think it is basically deductible expense. But as per law, no, that is basically capital in nature. You're allowed to make only the proportion of it into your deductible expenses. Now, one more is you can engage into a business which is taxable, which is exempt. Some of the element is maybe not for profit. So it's mean you have certain expenses which is you can identify this is for my taxable income. For example, I have a center where we do a lot of not-for-profit things, and at the same center we have a gift shop which is for profit. So it's mean one of the line item is exempt, but what the other is a taxable income. But we pay rent for the whole center. So the rent is basically is an expense, but it is, some of it is deductible, some of it is not deductible. So what we need to do is we need to identify if the expense portion of the expense is identifiable, just like in case of rent, we know we got the rent, let's say 150 dirham per square foot, and what is the overall size of the center. So we know exactly the shop rent, how much it should be. So we can identify the part of the expenditure. And some of the expenses, for example, it's the light, DWA bills and all that, still maybe we'll be able to figure out some identified parts which will be deductible, which will not be deductible, but we will still left with certain expenses which we cannot explicitly tell it is related to the exempt income or it is related to the taxable income. In that case, we will use apportionment. Right? Right. This is also the taxmen love this part. Whenever the tax investigations come, they normally touch this area, especially the entertainment expenditure. Now, as per the law, let's first cover entertainment expenditure. You can do a lot of things like, there's nothing harm to calling your customer, vendors, prospective customers, do the meetings with them, provide them accommodation and transportations, etc. But these will not be 100% allowed to deduct against your taxable income. Only 50% you can deduct. For example, altogether in 1 year, you spend 800,000 dirham. And that is basically deducting your income, and you have a certain profit. So you have to add back 50% of that expense. Similarly, for interest, they say 30% of your income. For example, you have a profit of 100,000 after deducting all the expenses, but before, we call it EBITDA, earnings before interest, tax, depreciation, and amortization. So that income, we will take the 30% of it. Up to that 30% only, we can use the interest expense. But if we have more interest expense, maybe we are dealing in mortgages, a lot of loans, then any unutilized interest expense can be carried forward for up to 10 tax periods. This is also very important, especially when we say we're starting a business and we got a loan from XYZ person instead of banks. And that XYZ person is a connected person or is a related party person. Then these, and just to make it look reasonable, we sometimes put commercial terms into it. Okay, I am lending money at 3%, for example. Even though I have no intention, but to make it look commercial, I put all these terms. Even then, the taxman will say it is not allowed to deduct that expense, that interest, if you take in the loan from a related party or connected person. We'll discuss the related party and connected person in a few minutes, unless we can demonstrate that this is not, the loan not being taken for any tax advantage. Here's another list. Basically, these are the ones which explicitly not allowed to reduce your taxable profit. And it is also interesting and a pointer for not-for-profit organization to think about it. They should register themselves as soon as possible as a qualifying public benefit company. Because of that, if they get any contribution, any membership fees, any grant from anyone, that person can take the tax advantage of it. So I cannot, do the charity to all different kind of organization from my profit and deduct it for the tax purposes unless they are qualifying public benefit company. And if we incur any penalties and fines in the normal course of business, that is not allowed to deduct. For example, late payment fine, late filing of VAT returns, traffic fines. Even though it's not a policing happening here. Nobody holding your hand. You cannot do it. You can pay as you want, but you will not be allowed to take to reduce your taxable profits. You have to add back into your accounting profit. Okay, bribe is a bit harsh word, but illicit payments and undocumented commissions. We know about it. Undocumented commissions is any commission which we pay to someone who has given us the business for a very genuine reason. But since there's no document, these kind of expenses will not be allowed. Unless the company is, you paying them the corporation tax, commission, and they are giving you invoice for it. And there is a commercial reason for it. Similarly, the term, let me just go back a slide. You guys know about this? Earning before interest, tax, depreciation, and amortization. So That term is very important. So the tax will apply on that profit. So it's not like, okay, we have a profit of 100,000, now we pay 9% tax, 9,000 we should also reduce. Maybe that 9,000 we paid for the last year, we reduce it from the profit. No, it is not allowed. So corporation tax, value-added tax liabilities, any foreign tax which we paid on our outside income, outside UAE income, these will not be allowed to deduct from your taxable income. Right, okay. Related party. This is a little, you can say, advanced level topic. I'll try to be brief and precise. Maybe you can come up with a lot of questions, but I think due to the circumstances in which, especially Iranian community operate businesses, these may be very much relevant. So what is related party as per the legislation? Your brother, your sister, your wife, your husband, your mother, your father, up to 4 kins. They all are related person. So if you are doing any transaction with them, this will be called as related party transactions. What it means is, these are the transactions which could be done on favorable basis rather than arm's length basis, market value basis. So it same apply for the jurisdictional person, where one company has at least 50% controlling control in the other company through ownership interest. These two companies also will be called related party. Another term, but before that, related party transaction need to be declared. So if we do in our business any related party transactions, these need to be declared in the corporation tax returns. Like, yes, we did related party transaction, and then we, for the transfer pricing purposes, we have to maintain certain documents which we later discussed, called master file, local file, and also through the related party transaction, if we work out the transfer of profit happens in between two tax jurisdictions, and in which it is damaged or impacted UAE tax collection, then these will need to be considered in when we work out the corporate tax liability. Another term is connected person. Connected person and related party person could be different. Connected person is more like, I'm the owner of the business, I'm a connected person for my business. My next kin is the connected person for my business. A director who is very highly influential, maybe he's not the owner, he's not the brother, he also can be a connected person. So when we talk about tax evasions, transfer pricing, any transactions with related party or connected persons, these are normally focused, and the government wants you to declare it. One last thing, payments to the connected person is deductible only if and to the extent the benefit corresponds with the market value of the services. I am the only owner of the company. I provide certain services. Now, since I have an IT background, I thought, okay, that's my business. Let's start providing some digital marketing services to my own company. Maybe the idea is to reduce taxable profit. And I charge my own company hell amount of money because I'm the only decision maker. I can make these kind of decisions. So I raise an invoice, give it to the company record that invoice, which resulted in a huge reduction in the profit. But what the law say, if you can deduct the expense, if the benefit corresponds with the market value. So for the same digital marketing, somebody in the market is ready to do for me, let's say 10,000 dirham per month, 100,000 maximum, and I charge my own company 1 million. Not justifiable. So whenever the related party transaction happen, we check the arm's length transactions. As long as we are doing online transaction, there's no adjustment in the corporation tax liability. What is online transaction is, if I do the same transaction with my unrelated party, open in the market, and I get the same financial impact, the cost or the price, then it's mean it is done at arm length or at the market value. If it is not done at arm length basis, then what happen is, the law say you need to check the arm length basis. Use these methods to find out, was there any movement of the profit. For example, we have a 9% and we moved a profit from UAE to a region where there is no tax. So those kind of methods will be used. By default, this is the most common method, comparable uncontrollable price method. These will be too much technical. I won't go into the detail, but whenever those related party transactions happen, as a business owner, our responsibility is to make a list or keep them separate. These need to be declared in the corporation tax return. And also, there will be two more documentation required, which is called master file and local file, which basically talk about how did I do pricing with my own related party. Okay. Now, tax relief. I hope you all are awake. I think we almost done half of the presentation. If anybody has any question, I can take a little break here as well.
Lot of questions, Ron.
Lot of questions. Just one question. I need break.
Anyway, okay. First of all, regarding the outside UAE taxes, in many countries they are accepting. For example, in India, you can make an agreement regarding this. But I think there is a limitation here for the out of the UAE taxes.
Okay. Let me take you by. You asked me a question which I wanted to discuss later on. So, in terms of conflict, if conflict occurs between tax law, international agreements, and international standards, where we have a double taxation relief, etc., but the law says something different. What it means is, in case of conflict between tax law and international standards, what will prevail? UAE tax law will prevail. But if the conflict is between UAE tax law and international agreements, the international agreements will prevail. I hope I answered the question. Right, okay. In some countries, tax losses normally you can offset against your current year taxable income 100%, but they allowed 75% basically. 75% of the taxable income can be reduced through tax relief, tax loss relief. What is tax loss? It's just opposite of taxable income. We normally call profit and loss simple. So when we call a loss, it does not mean it's a taxable loss. When we say profit, it does not mean it's a taxable income or taxable profit. We have to do the adjustments as per the tax year, as per the law of that tax year. Maybe today, this year is 9%, next year it can be 10%. So the losses could be different. So when we say tax loss, it means we have worked out our profit, we have added back many things, and now, as per accounting term, we made a profit, but from the tax point of view, actually, we made a loss. So those losses, definitely in that year, we will not be paying tax. That is the major difference between VAT and corporation tax. VAT, no matter, you are about to bankrupt. You collected the money on the behalf of the government. Before the bailiff come and to sell your assets, they say, we are the first priority. You need to pay us first. They don't bother about how your business done. But here, if they are since the partner in your profit, so just like any other partner will not get any distribution of the profit, the government will not get their part as well in term when there is a loss. But they also say, carry forward this loss. Maybe this year you made 5 million loss. but next year you made only 2 million income. Is it justifiable to pay taxes on it? Last year you were 5 million loss. This year you made 2 million. But altogether you are still in losses. How we can do it? Through tax relief, tax loss relief. So first year we have a minus 5 million. Next year we have a 2 million. Now, normally in some other regimes, you're allowed to completely set off your previous year loss against this year income. So 5 million will reduce to 3 million only. The 3 million will be carried forward. The 2 million will set off against the 2 million of the current year income. Here's the difference. But for the 2 million, they say you cannot completely set off against previous losses. You can only cover 75% of it. It means 1.5 million will be set off against this year 2 million profit, and you still have to pay tax on 500,000. But there are certain other limitations on the tax loss relief. We'll talk about maybe in some other sessions is ready. But thanks God we have tax loss relief which is available, which can be set off against the very first available tax income for that subsequent tax period. We cannot also keep carrying forward old tax losses. Was thinking about like after 3 years, 4 years, we will set off. No, with the very first available taxable profit, you have to utilize them.
For how many years? I mean, how many years you can carry
Normally,
losses?
thank you, sir. Normally, like in UK, 3 years, some other jurisdiction, 5 years. The law hasn't yet defined.
Okay.
Like for the interest, they say you can carry forward up to 10 years. But here the law is silent. So we wait for the executive regulation to talk about it. Another thing is you can pass on your loss to another business as long as you or they own 75% control in your business. And the same conditions we talk about. They must not be exempt. They must have the same financial year. They must follow the same accounting standards. This is a very important point. A limitation on tax losses carried forward. So the period in which we incurred losses, let's say there's a separate owner. And now when new owners took over, they are new owners, right? In that case, there is a limitation. At least 50% of the shareholding should remain same, which should be the same in the period where the losses happen and where you're going to set off against. For example, 2021 you have losses, you have one partner, two partners, same partner, and the same partner carrying on in 2023 and 22, then you can set off the losses against it. But if all of the partner left and the new partners coming, you cannot use those tax losses. But if there were two partners, so only one left, it means you still have 50% same ownership carrying on from the previous years, so they can utilize the tax losses. Tax growth. I'll be a bit quick here. Qualifying group was different. If you remember, we talked about 75%. So the transactions happening between two different entities, you can get the benefit of not considering for taxable income because they were owning each other 75%. But the tax group has its own benefits. And the condition is they must own the company 95% directly or indirectly. And again, same financial year and same accounting policies. If they're fulfilling these conditions, the parent company can ask tax office to register a tax group with the formation of all the subsidiaries. So in that case, the tax group will be formed and they will be required to submit one tax return based on consolidated financials. Now the consolidated financials, how the earnings of the group will be worked out. They have to prepare the consolidated financials. They have to eliminate transactions between them. And when we talk about the tax group, they can also have losses. A tax group has a losses, later on a new entity join them. Then the new entity join them, we cannot set off losses against the income of that new member. And similarly, when the existing, when let's say parent company dissolve, all individual companies cannot utilize losses. If the parent company ceases to be a taxable period, the tax losses of the tax group shall not be available for individual subsidiaries with exception. There are some exceptions. In law, there are always exceptions. Okay. So when we talk about corporation tax calculations, we talk about the currency in which it will be reported. It will be AED. Time period we discussed, it's 9 months. Foreign tax credit will be available for local taxpayer, and withholding tax credit will be available for non-resident taxpayer. So there are some administration which we will do later on once we have the executive regulation come. That's about we have to register for the taxes. We need to produce financial statements, but what kind of financial statements? Should it be audited? Should it be unaudited? Which accounting standards they will accept? Transfer pricing documentation we will be required, in which we need to prepare master file which talk about the whole group, their group level strategy, etc. Local file for the on the individual transaction basis. These must be prepared because at any point in time, if the government asks, you have only 30 days to respond back. Record keeping is mandatory for 7 years, unlike VAT where it says 5 years. Tax periods, again, we need to see when we need to file the tax return. If we do not register in time, file corporation tax return in time, make payment in time, there will be some penalties. But these will come in the executive regulations. Transitional rules, especially, for example, your financial year start from 1st of November 2023. What happened from 1st of June till 31st of October? Many companies still, let's say if your tax year, if my tax year is starting on 1st of June 2023, I will pay tax for that period. Not many other companies will pay tax on that period because their financial year start later on. So the transitional rules will talk about it. Conflicts, I think we discussed already. Right, okay. That's important. I'll take only a few minutes on it. Now from here, what we need to do. We did this session just for the awareness. Number two thing, I think what we should do is we need to, if our books of accounts are not up to date, as per the standards, we should get it ready. Segregation of personal and business expenses is very important. If we have business through different entities, because in UAE you are allowed to do certain activities with one license, then you go again for another license. So it is very common for people having more than one licenses and more than one company. So they need to think about what kind of tax group structure they should go for, which is beneficial for them when they should do the tax planning. Also, they need to determine, is it really going to applicable on them? From which year? The 9% is very important. Though it looks small as compared to rest of the world, where the taxes are 30, 40 years ago, the average was about 40%. Now it is reduced to about 25 to 30%. Still corporation tax in the worldwide. 9% looks very small, but we are in the habit of operating without taxes. Yeah. So that 9% can impact psychologically and can also have an impact in terms of panic in the market. So you need to think about your own pricing strategy. Should you really pass on the impact? How your competitors are working on it? And how can you improve, make your own operation bit more cost efficient so you can bear the 9%. Realignment undocumented expenses is very important. You may be doing transactions with rest of the world based on understanding 15 years ago established, no more documentation. It's giving you a business, we're passing on the commission. But we need to revise those contracts. We need to bring them in writing if we really want to take the advantage of 9%. Otherwise, you can say a commission of 100,000 is actually costing you 109,000. Because of that, your tax bill will be increased. Related party is very important, especially we understand the kind of environment in which many people operate where they cannot provide direct support to the businesses in back home. So they do business on their behalf as an agent. So it's very important for you basically involve with the people who do the transactions with you. They are connected with you. They are the related party. Should the agency principal agreement good enough? Should you think about any other restructuring model? The sanctions risks are there. So many things. So this is very hot topic, and it is especially linked with if you are doing businesses on behalf of others. So, here you go. I'm sorry I've taken so much of your time, but I think I tried to cover most of the important part of the text. Thank you.
Thank you.